Someone asks you, "What's your trading strategy?" You start explaining, "Well, I look for support and resistance. I check if the trend is up or down. I look at a few candlestick patterns. Sometimes I use this indicator. It kind of depends on how the chart looks." That's not a strategy, that's a vibe. And trading on vibes is why most beginners can't tell if what they're doing actually works. You have no specific rules to test, no specific rules to follow, and no way to know if you're improving or just getting lucky sometimes and unlucky other times. A trading plan is different from a trading system. We covered systems a few videos back. That's your routine and process. A trading plan is the actual document that defines your specific strategy, the exact rules for entry, exit, and everything in between. Today I'm teaching you how to write one from scratch, even if you've never written anything like this before. Quick reminder, 2 free resources in the description: the Professional Trader's Emergency Protocol and the Trader Psychology and Risk Management Workbook. Both will help you as you build out your trading plan, completely free. If you're following along with this series, subscribe. We're building your complete trading foundation piece by piece. Let's write your trading plan. A trading plan answers 5 specific questions in writing. What will I trade? When will I enter? Where will I exit if I'm wrong? Where will I exit if I'm right? And how much will I risk? If you can't answer all 5 of these questions in one sentence each, you don't have a trading plan. You have an idea. Let me walk through each question and show you exactly how to answer it properly. Question 1. What will I trade? This seems simple, but most beginners skip defining it clearly. You need to specify the exact markets or instruments you're trading, not Forex generally. Specifically which pairs, euro against dollar, pound against dollar, whatever you chose after watching the previous video on choosing your market. Write this down literally. I trade EUR/USD and GBP/USD. That's it. This prevents you from randomly jumping into unfamiliar instruments because you saw something moving on social media. You have a defined universe of what you trade, nothing outside that universe, at least not until you've deliberately expanded your plan. Question 2. When will I enter? This is the core of your strategy, and it needs to be specific enough that someone else could follow your rules without you being there. Vague answers like, "When it looks good, don't count." You need conditions that can be objectively verified. Here's an example of a specific entry rule. I enter a buy when price is in an uptrend, defined as higher highs and higher lows on the 4-hour chart, and price pulls back to a previous support level, and a bullish candle forms at that support level showing rejection of lower prices. Notice how specific that is. Uptrend defined clearly. Pull back to a specific level, confirmation candle required. Someone else reading this rule could look at the same chart and identify the same entry point you would. That's what makes it a real rule instead of just a feeling. Your entry rule might be different based on your strategy. Maybe you trade breakouts instead of pullbacks. Maybe you use a different time frame. The specific rule doesn't matter as much as the specificity itself. Write down exactly what needs to happen on the chart before you click buy or sell. Question 3. Where will I exit if I'm wrong? This is your stop loss placement, which we covered in detail in an earlier video. But in your trading plan, you write down the specific method you'll use every time. My stop loss is placed below the most recent swing low with 10 pips of additional buffer. This needs to be consistent. You're not deciding stop placement differently on each trade based on how you feel. You have one method, written down, applied every single time. Question 4. Where will I exit if I'm right? This is your profit target, also covered in an earlier video. Write down your specific method. My target is the next significant resistance level, or 3 times my risk distance, whichever comes first. Again, consistency matters here. One method, applied every time, not decided emotionally while watching the trade develop. Question 5. How much will I risk? This connects to the position sizing video we covered. Write down your specific risk percentage. I risk 1% of my account balance per trade. This number should be the same on every single trade, regardless of how confident you feel. Once you've answered these 5 questions specifically and written them down, you have the core of your trading plan. But there are a few additional sections that make your plan complete and ready for real use. Section 6 is your trading hours. Write down exactly when you'll be looking for trades. I trade between 8 a.m. and 11 a.m. during the London session, or whatever hours work for your schedule and your chosen market. This prevents you from trading at random times when you happen to be near your screen, often when liquidity is poor or your own energy is low. Section 7 is your maximum daily limits. Write down maximum number of trades per day, maximum loss per day before you stop trading, and what happens if you hit that limit. I take a maximum of 3 trades per day. If I lose 2% of my account in one day, I stop trading for the rest of the day. 20 equate. These limits protect you from emotional spirals where one bad trade leads to revenge trading, which leads to more bad trades. Section 8 is your trade invalidation rules. This is different from your stop loss. Sometimes a trade setup disappears before you even enter, or conditions change while you're managing an open position in ways that aren't captured by your stop loss alone. Write down, if price breaks below my entry trigger level before I enter, I do not chase the trade. If major economic news is scheduled within 30 minutes of my planned entry, I wait until after the news releases. These rules prevent common beginner mistakes like chasing trades that have already moved past the ideal entry, or getting caught in unpredictable volatility around news events. Now let me show you a complete example of what a finished trading plan looks like, combining everything we've covered. Market. I trade Euro USD and GBP USD only. Entry rule. I enter a buy when the 4-hour chart shows higher highs and higher lows, indicating an uptrend, and price pulls back to a clearly identified support level, and a bullish reversal candle forms at that support level. Stop loss. My stop is placed 10 pips below the support level or below the most recent swing low, whichever is further from my entry. Profit target. My target is the next clear resistance level on the 4-hour chart, or 3 times my risk, whichever is reached first. Position sizing. I risk 1% of my account balance per trade, calculated based on the distance between my entry and my stop. Trading hours. I look for setups between 7 a.m. and 11 a.m. during the London session. Daily limits. I take a maximum of 2 trades per day. If I lose 1.5% of my account in a single day, I stop trading for the rest of that day. Invalidation rules. If price breaks below my support level before I enter, I do not chase the trade and wait for a new setup. If major economic news affecting UR or GBP is scheduled within 30 minutes, I wait until after the announcement before entering. That's a complete trading plan. Notice it's not complicated. It's specific. Every decision point is defined in advance. There's no ambiguity about what to do when you're actually looking at a live chart. Now let me explain why having this written down matters so much, beyond just having clarity. When your trading plan exists only in your head, it bends. You convince yourself that this particular trade is an exception. You tell yourself the rules don't quite apply this time because the setup looks really good. Your brain rationalizes breaking rules that only exist as vague memories. But when your trading plan is written down in specific, objective language, it's much harder to rationalize breaking it. You can look at the actual document. Does this trade meet Rule 1? Yes or no? Does it meet Rule 2? Yes or no? There's no room for, it kind of meets the criteria, or close enough. Either it meets your written rules or it doesn't. This is why professional traders treat their trading plan like a legal document, not a loose guideline. It's binding. You follow it exactly as written, or you don't take the trade. The discipline doesn't come from willpower in the moment. It comes from having clear, unambiguous rules established before emotions are involved. Let me address how to actually create your specific rules if you're not sure what they should be yet. This is where backtesting comes in. Before you risk real money, you look at historical charts and you practice identifying your potential entry, exit, and stop conditions. You're essentially testing your rule ideas against past price action to see if they would have worked. Pull up a chart. Go back several months, scroll through slowly, candle by candle, pretending you're seeing it in real time. When you spot what looks like your entry condition, mark it. Then continue scrolling to see what would have happened. Would your stop have been hit? Would your target have been reached? Do this for at least 50 potential setups before you start risking real money. This process does 2 things. First, it helps you refine your specific rules. Maybe your initial idea of uptrend plus pullback needs more precision because you're seeing too many false signals. You adjust the rule to be more specific. Second, it builds your pattern recognition. By the time you're trading live, you've already seen 50 examples of what your setup looks like. You're not guessing anymore. Let me also address what to do once you have your trading plan written down. The plan isn't permanent and unchangeable forever, but it shouldn't change based on emotional reactions to individual trades. Here's the rule. You only modify your trading plan during scheduled review periods, not during or immediately after a trade. If you have a losing trade and you immediately think, maybe I should change my stop-loss method, that's an emotional reaction. Don't act on it. Instead, note it down and bring it up during your weekly or monthly review, which we covered in the Trading Journal video. During that calm review period, you look at your data. Has this stop-loss method actually been underperforming across many trades, or was this just one normal loss? Then you decide if a change is warranted. This separation between emotional reaction and planned modification protects your trading plan from being changed too frequently based on short-term variance. Remember, even good strategies have losing trades. If you change your plan every time you lose, you're not actually testing whether your plan works. You're just reactively tweaking forever, without ever finding out if your original rules had an edge. Now let me give you the simple process for creating your own trading plan, step by step, starting today. Step 1. Choose your market. If you watched the previous video, you've already done this. Write it down as the first line of your plan. Step 2. Define your entry rule. Look at your chosen market's chart. What pattern or condition has historically preceded good moves? Start with something simple, like trend plus pullback to support, or breakout above resistance with volume confirmation. Write the specific objective conditions. Step 3. Define your stop-loss method. Use one of the methods we covered in the stop-loss video. Support and resistance, swing high and low, or ATR-based. Pick one and write it down. Step 4. Define your profit target method. Use one of the methods from the profit target video, support and resistance, risk to reward ratio, or technical levels. Pick one and write it down. Step 5. Define your position sizing rule. What percentage of your account will you risk per trade? Write down the specific percentage. Step 6. Define your trading hours and daily limits. When will you trade? How many trades maximum per day? What's your daily loss limit? Step 7. Define your invalidation rules. What situations mean you don't take a trade even if it initially looked good? Step 8. Backtest your rules. Go through historical charts and verify your rules would have worked reasonably well. Adjust if needed. Step 9. Write the complete plan as one document. Keep it somewhere you'll see it before every trading session. Step 10. Follow it exactly for at least 50 trades before making any modifications, except for genuine emergencies discovered through backtesting that you missed. That's your complete process. It takes real time and effort to create a proper trading plan. Most beginners skip this work because it feels tedious compared to just opening the charts and trading. But this upfront work is what separates traders who can actually evaluate their performance from traders who are just guessing forever. So to wrap this up, a trading plan is a written document answering 5 core questions: what to trade, when to enter, where to exit if wrong, where to exit if right, and how much to risk. Additional sections cover trading hours, daily limits, and invalidation rules. Writing it down in specific, objective language prevents emotional rule bending. Backtesting helps you refine your rules before risking real money. You only modify your plan during scheduled reviews, not emotional reactions to individual trades. The 10-step process takes you from nothing to a complete, testable trading plan. If this helped you, subscribe. Next video continues building your practical trading foundation. Download both free resources from the description. They'll support you as you develop and refine your trading plan. Stop trading on vibes, write down your actual rules. That's the difference between gambling and trading.